Well, Moody's cut Greece's credit rating to junk. As a result, bonds of almost all the so-called peripheral Euro region nations are trading lower. That is, if you compare them to German bonds. With us now on the phone is Bloomberg contributing editor Keith McCullough. He is joining us to take on a little European debt tour, Keith, I guess is what we can call it. I'm looking at Ireland, Spain, Greece's bonds, all moving lower. It's not a surprise. So why is the market reacting like this?
Yeah, these rating agencies, Deirdre, we've talked about this before, they are the most classic lagging indicators. So if you're waiting for Moody's or S&P to tell you what to do and when, I mean, you're going to be really late to the party. Obviously, markets have been marking down Greek and Spanish bonds and stock markets, for that matter, for the last 6 to 9 months. So, here we are today, and the Johnny-come-latelys come in. But at the end of the day, what I do is I look at Spanish debt yields, as you said, pushing higher. Very important 12-month and 18-month auctions here on the Spanish debt side this morning. You see a 2.3% yield on that for Spanish debt on 12-month. That's versus 1.59% last month. So the reality is spreads continue to widen and yields continue to heighten.
Keith, as you say, for the ratings agencies, they come late to the game. Almost everyone's in agreement of that. But then why is the market responding like this? Is it highlighting something else that's to come?
Well, I think that, we basically call this the sovereign debt dichotomy. So what that means is that sovereign debt issues won't happen in a vacuum. They're going to happen one by one. And what the market's really concerned about is what Mr. Market is telling them, which is after Spain, you're going to have issues in France and the UK, and then we're going to have issues in the USA. Now, last night, Obama's administration released a revised estimate on the deficit side, which to me was a very alarming number, a $1.6 trillion deficit estimate for 2011. That's a huge number, and that's pushing us closer to where Greece is as a deficit as a percentage of GDP, which is a big problem.
But, Keith, in all fairness, it doesn't seem like you can really compare the U.S. and Greece. I mean, the difference in what each economy produces, just on that fact alone, sets us apart, does it not?
Well, against Greece, that's fair. Let's consider Spain then. Spain, USA looks worse than Spain on both debt to GDP and deficit to GDP if you're using the forward projection as opposed to the lagging indicator, which is what S&P and Moody's use. So obviously our debt to GDP ratios are higher than Spain's. Most people know that. We're bigger, and we're in a position here where we're actually not addressing the issue, whereas the Europeans are implementing austerity measures, and here we are in the USA just not willing to admit that truth.
Although there's other things, not to be too patriotic here, Keith, but I feel like we should point out some good stats for the U.S. While our unemployment is high, it is nowhere near Spain's, which is clearly the highest in the Euro region. I mean, especially for the youth group in Spain, it's up around 20%.
Yeah, well, God help us if we're going there. But at the end of the day, a 20% unemployment rate, you can take that and try to get that and wrap your head around it if you want. A 10% unemployment rate in this country isn't going to get us anywhere in the area code of the GDP estimate that both the administration and consensus has embedded in their deficit to GDP forecast. The growth forecasts, Deirdre, are really based on unemployment coming down from 9-10%, and it's not.
What about the issue that many people point out is that in the U.S., Keith, we seem to have this mix of both public and private debt. A lot of people, when they talk about Spain and some of the concerns there, point to the fact that their housing bubble is mostly private. Don't you think that puts the U.S. in a better light?
Oh, my God, no. I mean, if you look at the public debt and the private debt combined in this country, we look way worse. I mean, we have $56 trillion in debt if you combine the whole thing and not include, the GSE debt. So, our debt balloon is massive. It's the biggest debt bubble in world history. We know it. Everybody else in the world knows it. And that's why last night, the Chinese last night said, quote, unquote, the U.S. needs to seriously consider the structural problems and not blame others. Like the rest of the world clearly sees this.
Keith, that's the last word. Thanks very much for your insight. Keith McCullough, founder and CEO of Hedgeye Risk Management.